Netflix will report results tonight after the close, and to prepare, we're going to take a look at the guidance that management gave us from the fourth quarter shareholder letter. It's on the first page in the column all the way to the far right. And we're going to compare that guidance to consensus estimates to see if the street is in line with guidance heading into the release. So to do that, we'll be using our Netflix earnings model, which you can download on our website for free, gutenbergresearch.com. You can, from the homepage, just click on this Models tab, and then scroll down to Netflix, and then just click this icon here, and you can see it downloads instantly for free, and you don't have to log in any longer. So it's much easier. Before we get started on the modeling, there's one important announcement that came out this morning from Amazon, and that is that they're going to be doing a video-only version of Prime for $8.99 a month. And the reason that that is so important is if you scroll down to the second page of last quarter's shareholder letter, management reminded us that the old pricing for Netflix HD of $7.99 a month will be expiring over the second and third quarter. So now it's going to be going to $9.99 a month. So Amazon has basically announced that they're going to undercut Netflix price by $1 per month. And this announcement comes on the day of the Netflix earnings release. So this is definitely going to be an exciting call. It'll be interesting to see what management does in response to the Amazon announcement. They may change their pricing strategy. It would be a little difficult for them to do that today, especially because they must have already figured out what their guidance for the second quarter is. So this is just going to be a really important call to listen into. Now let's go through our earnings model. So bring that up, and before we even get into the details of management's guidance versus consensus estimates or anything like that, we're just going to ground you in what exactly we're looking at, make it a little bit easier for you to follow along. And let me just freeze the panes here and blow it up a little bit. Actually, I'll expand the historic details, and then we'll scroll over. Okay, so this is the quarter that we're looking at, the March quarter. And basically the top section is just the income statement, so pretty easy to follow. You can reconcile those numbers back through history based on what management has reported in the past, looking at SEC filings and the press releases. And then the section below the income statement is the segment details, and this is what we use to build our future income statement. So you can see that we've basically segmented the results the same way that management does. So you have a section for domestic streaming, a section for international streaming, and then a section for the DVD business. And then if you go to each one of the streaming businesses, you can see that all we're doing is taking the total number of members and multiplying that subscription base by an average revenue per member. So that's the subscription fee over the entire quarter. And that gets us back to revenue. And so, you know, in the revenue line of the income statement, we're just adding the three different businesses. So this is domestic streaming, this is international streaming, and this is the DVD revenue. So you can see how we build out the income statement. And then for each segment, we also give a gross margin percentage and a contribution margin percentage estimate. And that's just consistent with the way that management gives us guidance. So it makes it a little easier to follow. So next, let's take a look and see if these consensus estimates actually get us back to management's guidance. So we'll look at the domestic streaming first. So management gave us a few metrics here. So we'll go back to the fourth quarter shareholder letter. And for the U.S. streaming business, they expect revenue to be $1.16 billion. So we scroll here, and you can see we're a little bit ahead of that, and we've added comments to actually show what management's guidance is. So we're a little bit ahead of that revenue number, and that's really just so we could get back to the total consensus revenue estimate. So for total revenue, management gave us $1.8 billion, and that's for just the streaming. So they don't actually give us guidance for DVD, but 1.8 is pretty close. So we've got 1.16 for domestic, and then we have 0.653. So that gets us back to 1.818. So pretty close to what management gave us, 1.813. So not a huge difference there. Then on the, what's the next metric? So they gave us total domestic members, 45.4. Let's take a look at the total that they gave us. So total paid members, 45.4. So perfectly in line with the total U.S. subscribers. Let's take a look at the international streaming side. So we have in our model 31.8, which is in line with what management gave us. So you can see right here, 31.79 total paid members for international streaming. International streaming revenue is spot on, exactly with what management gave us from last quarter, $653 million. And then the contribution margin for international is in line with what management gave us at a loss of 17.5%. And then if you scroll down and take a look at our assumptions for DVD, so remember, management didn't actually give us any guidance for DVD business. So we just have it pretty consistent with what it's looked like in the past couple of quarters. So we've had declines, spike in the June and September quarter, and then kind of came down from there. We just had it at a reduction of 3.5% quarter over quarter in total subscriptions. And then our DVD gross margin is 48%, which is about the average from the last couple of quarters. But this is not really a huge contributor to total earnings, so this will not really have much of an impact tonight. So then we can scroll back up to the income statement, and we can just take a look at what we end up with here. So when we put in those factors, we kept some constant growth rates for the share count, and it got us back to EPS on a GAAP basis of 3 cents, which is in line with the guidance that management gave us. And here's an important point, too, that we want to discuss. So we've gotten a couple of questions about why the consensus EPS estimate is so much different than the guidance that management gave. So management said that EPS is going to be 3 cents. But if you look at the consensus estimate, it's more like 9 cents per share, which is 3 times what management guided to last quarter. And the reason is you're comparing, if you're doing that type of comparison, you're actually comparing management's GAAP EPS estimate with the non-GAAP EPS estimate from the street. So if you look at the GAAP EPS consensus estimate, it's actually 3 cents in line with management. So what the street is actually doing is they're taking stock-based compensation out of the estimate for total diluted non-GAAP EPS, and that's where the 9 cents comes into play. So that's a little complex. We're going to go through the calculation now. And this is actually a really important point here because the way that Netflix reports non-GAAP adjustments is a little strange when you compare it to some of their competitors. So if you scroll down below the income statement, below the ratio section in our model, you can see we do a little breakdown of non-GAAP items. So here's the calculation of non-GAAP adjusted EBITDA, and then we've got some non-GAAP adjustments here below that. So you'll see, and let's take a look at the fourth quarter from last year. You can see that this presentation of non-GAAP EBITDA is what management actually gave us in the shareholder letter. In fact, we'll go to that really quick. It's the last page of the letter. So you can see they do this reconciliation of non-GAAP adjusted EBITDA, and they actually back out stock-based compensation in the last row, which is very common for non-GAAP adjustments. You usually take the amortization of intangibles and stock-based compensation. In this case, it's a little difficult to break out the amortization of intangibles from other depreciation and amortization, so we'll just ignore that. It's usually not that significant anyway, but we'll just focus on stock-based compensation. So if you look at any other tech company, they're going to take out stock-based compensation from gross profit and operating profit, net income, and non-GAAP EPS. But if you take a look at the Netflix calculation of net income and EPS on a non-GAAP basis, they're only adjusting for the release of the tax accrual. They haven't actually adjusted for stock-based compensation in net income and EPS. So that makes it a little difficult because on the one hand, you want to be comparable to other companies, but on the other hand, you still need to present things the way that the company is presenting them. Otherwise, your non-GAAP EPS and net income is not going to tie to what management did. So what we did here is we took our usual approach and we added an adjustment for stock-based compensation in row 20. So that gets us to a non-GAAP operating income. And we also showed just the release of the tax accrual, the adjustment to net income, the same way that the company has actually reported it. So we have net income on a GAAP basis here in this row. Then we have net income on a non-GAAP basis as the company reported, with just showing the tax accrual adjustment. Then we also show net income on a non-GAAP basis, including the tax accrual adjustment and the stock-based compensation adjustment. So that's in this row here. So when you get down to our diluted EPS on a non-GAAP basis, you can see that we're reporting those two rows. So long story short, if you're taking a look at the consensus EPS estimate and you see 9 cents, it's because you're looking at a non-GAAP number, and all the analysts from the street are backing out stock-based compensation from that number. So it's not that they're 3 times as high as the diluted EPS estimate that management gave us in the shareholder letter. So if you go back to the first page, you cannot compare this 3 cents here to that 9 cents consensus EPS estimate, because you're not comparing apples to apples. You're comparing a GAAP EPS estimate to a non-GAAP consensus estimate. So that's the reason for the discrepancy. We've had a couple of questions on that. Hopefully that clarifies what you're actually looking at there. Next, let's take a look at the share valuation heading into this release. So for that, we're going to scroll down below our financial statements to the valuation sections. So we're going to talk about the multiple valuation, which you can see starts here in row 193. We also have a discounted cash flow valuation. We're not going to go through all the details. There's a number of assumptions that go into that calculation. If you'd like to play with some of those metrics, feel free to download this model and do it on your own. But for this earnings release, we're going to really focus on our multiple-based valuation. And the reason we do that is we want to isolate the impact of the valuation tonight after the earnings call to just changes in earnings. So we're going to update this first quarter column, and then we're also going to update the June quarter column for the guidance that management gives us. And then keeping this multiple stable, we can just see what the valuation impact should be. That way we can decide if the after hours move makes sense or not. So you can see right off the bat, we're using a 2017 price earnings ratio, so we're not using a next 12 month. And the reason we do that is Netflix is in a hyper growth stage and their earnings are pretty close to break even. So remember, we are looking at 3 cents of EPS on a GAAP basis for this quarter. So the multiple, if you look at it from a next 12 month standpoint, really just looks absurd. It doesn't really make a whole lot of sense. So if you go out one year to 2017, it makes a little bit more sense. Even still, these multiples are very high. So you can see that right now shares are trading at about a multiple of 77 times the 2017 consensus EPS. So still very high, but definitely makes more sense than the 2016 EPS base multiple. So right now that is close to the 3-month high. So the average is about 69 times. The high is 79, and we have it at 77 times. That's where it's trading right now heading into the release. So feel free to download this model. You can change this multiple to what you think is appropriate. You can also change the metrics in the DCF, and you can change any of the growth assumptions as well up here in the segment details. Be sure to join us tonight after the conference call, about 6 p.m. Eastern time or so. We'll update this March quarter column and this June quarter column, and we'll see what the impact is on EPS and net earnings, and we'll also see what the impact is on valuation per share. Now, before we sign off, I'd like to remind you that our videos, models, and other content are for demonstration purposes only and do not represent investment advice. By viewing, you are deemed to have agreed to our full terms of use, which are available on our website, gutenbergresearch.com. If you're new to our site, please download our free ebook by clicking the thumbnail in the lower left-hand corner of your screen. This goes through our entire approach to financial modeling and equity valuation. We also have a 5-video modeling tutorial series, which you can access by clicking the video in the upper right-hand corner of your screen. And we've included an earnings preview and earnings review video here as well to give you a better idea of what to expect from each type of video. If you're interested in financial modeling, please click the button to subscribe to our YouTube channel. And since we do not always post our review videos to YouTube, please follow us on Facebook using the link in the description section below to stay up to date with all of our model changes. Thanks for watching, and good luck with the rest of earnings season.